Welcome to TalkTickers. You're looking for the essential insights from the latest earnings calls, and today we're diving straight into the first quarter report.
Yeah, let's get into it.
The big picture, well, it was a bit of a mixed bag, really. We saw some headwinds impacting the quarter, but the company is standing firm on its outlook for the rest of the year.
That's the key takeaway up front, yeah.
So let's break down what actually drove these results and, what the management team anticipates moving forward.
Okay. So first quarter revenue came in at $1.1 billion, basically flat compared to the year before.
Flat, okay. And earnings?
Adjusted EPS was $3.61. That's actually down 3% year over year.
Right.
Looking at the segments, Carlisle Construction Materials, CCM, they brought in $799 million. That's up 2%.
A modest increase there.
Yeah. But then Carlisle Weatherproofing Technologies, CWT, reported $297 million. That one was down 5%.
Okay, so a bit of divergence between the two.
Definitely. Also notable, the company repurchased 1.2 million shares, spent $400 million doing that in Q1.
Wow, significant buyback activity.
Yeah. And importantly, looking ahead, the free cash flow projection for 2025. Still holding at approximately $1 billion.
And a long-term goal, that Vision 2030?
Still on track, they say. Targeting $40 plus in EPS by then.
Okay, so flat revenue overall.
Yeah.
But it sounds like there were different things pushing and pulling there. Acquisitions helped, right?
Absolutely. Acquisitions like NTL, Plastafab, and Thermofome, they added a good $50 million to the top line.
$50 million, okay.
But, this gain was pretty much offset by several challenges.
Such as?
Well, we saw a slowdown in residential construction. That was one factor. Then there was some pretty significant unfavorable weather, especially back in January and February.
Right. Weather always plays a part.
And, the ongoing uncertainty in the broader economy, particularly around tariffs. So while acquisitions added revenue, these other things kind of held back the overall growth.
Makes sense. And when we look at those individual segments, CCM's slight growth, you said 2%, seems tied to a specific area.
Yes, very much so. CCM's growth was really driven by strong activity in the re-roofing market.
Ah, re-roofing.
Yeah, and that makes up a huge chunk, like 70% of their commercial business. The MTL acquisition also gave them a boost there.
So those offset other weaknesses.
Exactly. Those strong points helped counteract, softer demand in new commercial construction, tougher comparisons to last year's weather, which was milder.
Right.
And also some low single-digit price declines they experienced. It really seems like that focus on re-roofing is giving them some resilience.
Okay. While CWT's 5% decline, that sounds like it really points to the difficulties in the housing market right now.
Exactly. That's the story there. The decrease in CWT's revenue reflects those continued challenges in residential end markets.
Like what specifically?
Things like buyer uncertainty, affordability issues, with higher interest rates and just lower turnover of existing homes. All that's having an impact.
Gotcha.
Plus, they also saw less demand for their roof coatings, which they partly blamed on just fewer rainy days in the quarter.
Interesting. Okay. Let's switch gears to profitability. Margins and EPS took a bit of a hit, didn't they?
That's right. The overall adjusted EBITDA margin for the quarter was 21.8%.
And how does that compare?
That's down 240 basis points compared to last year, so a 2.4 percentage point decline.
Okay.
And as we mentioned, adjusted EPS also decreased by 3%. Management basically pointed to lower overall sales volume, unfavorable dynamics between their pricing and their costs, and also ongoing investments they're making in the business. Those were the main reasons cited.
So how did those profitability challenges break down by segment? CCM saw a decrease, even though revenue was up slightly.
Yeah, that's correct. CCM's adjusted EBITDA was $217 million, which is down 5%.
Okay.
And its margin was 27.1%, down 180 basis points. They mentioned lower carryover pricing from, previous periods.
Right.
And their investments in innovation as factors compressing that margin. Although the synergies they're getting from that MTL deal did help offset it somewhat.
And the hit was even bigger for CWT.
Oh, yeah. Much more pronounced for CWT. Their adjusted EBITDA was $46 million. That's a big drop, 28% down.
Wow.
Which led to a margin of just 15.6%. That's down a hefty 510 basis points from last year.
What drove that big drop?
Well, it was largely due to deleverage from the lower revenue. When you sell less, your fixed costs hit profitability harder.
Makes sense.
Plus those negative price cost dynamics we talked about earlier. However, management did sound pretty optimistic that upcoming automation projects and their efforts to gain market share will start turning things around starting in Q2.
Okay, something to watch. Now, regarding those price cost dynamics, Both segments saw some price declines in Q1. What's the outlook there?
Yeah, both CCM and CWT experienced low single-digit price declines. Looking ahead to Q2, though, the company anticipates year-over-year pricing will probably be neutral for both segments.
Neutral, okay. Why the change?
Well, they expect that recently announced price increases, plus the usual pickup in construction as we head into summer, should help stabilize things on the pricing front.
And what about the other side of that equation, their costs? Raw materials.
They're projecting raw material cost will be pretty much neutral for the full year.
Yeah.
The current thinking is maybe a slight positive impact in the first half, then a slight negative impact in the second half. That's assuming, of course, no more big tariff increases.
Right. The tariff wild card.
Exactly. They also said the direct impact of current tariffs in 2025 should be minimal. Apparently, over 90% of their sourcing is within North America, USMCA included.
That helps.
It does, though they did acknowledge indirect impacts are harder to pin down, but seem minor for now.
Okay. It also sounds like the company is really focused on returning capital to shareholders. Lots of buybacks, dividends.
Absolutely, very much so. In Q1 alone, like we said, $400 million to repurchase 1.2 million shares.
And that brings the total since 2017 up quite a bit.
Yep, up to $5 billion in total repurchases since then. And they've actually upped their full year 2025 projection for buybacks. Used to be $800 million.
And now?
Now it's approximately $1 billion projected for this year.
$1 billion in buybacks.
Wow. Plus, they raised their dividend pretty significantly, 17.6% last August. That marks, get this, 48 consecutive years of dividend increases.
48 years. That's impressive consistency.
It really is. And their stated financial goals include keeping ROIC, that's return on invested capital, above 25%.
The key metric.
Right. And they plan to keep investing to strategic M&A, key initiatives, capital expenditures, balancing returns with investment.
Okay, so despite those Q1 challenges, the fact they reaffirmed the full year outlook, that suggests confidence, doesn't it?
It certainly does. They are still expecting mid-single-digit revenue growth for the full year 2025.
They did single digits, okay.
And they're also projecting around 50 basis points of expansion in their adjusted EBITDA margin for the year.
So growth and margin expansion expected overall. How does that break down by segment for the full year?
Well, for CCM, they expect mid-single-digit revenue growth too, driven largely by that resilient re-roofing market and the contribution from MTL.
And margins.
Margin expansion expected there as well, helped by price increases, gaining traction, volume leverage, and operational efficiencies.
Okay. But you mentioned something about Q2 for CCM.
Yes. Good point. Need to keep in mind, CCM's Q2 results will likely sit a bit of a negative impact. Yeah. Apparently, some Canadian customers pulled purchases forward into Q1.
Why?
Ahead of anticipated tariff-related price increases up there. So a bit of a timing shift to be aware of for Q2.
Got it. And the outlook for CWT sounds like that hinges on improvements later in the year.
Exactly right. For CWT, they're anticipating high single-digit revenue growth for the full year.
High single digits. Where's that coming from after the Q1 decline?
Primarily, they expect it from gaining market share, plus the full year impact of those Plastafab and Thermofome acquisitions kicking in.
Okay.
And they're also forecasting margin improvements there as they get synergies from those deals and as their automation projects start delivering benefits.
So putting it all together for the year.
Overall, the expectation is for full-year adjusted EPS growth to be over 10%, while keeping that ROIC above 25% and free cash flow margin above 15%.
It's interesting hearing about the underlying trends, like the age of buildings. That seems like a really significant long-term factor for them.
It really does. I mean, the data they shared, roughly 70% of U.S. non-residential buildings are over 25 years old.
70%.
Yeah. That represents a huge and pretty consistent demand driver for re-roofing. And get this, over 80% of re-roofing permits are actually for buildings in that age group.
Wow. So not just replacement, it's upgrades too.
Exactly. They're seeing an increase in the amount of content per square foot on these jobs.
Why is that?
Several reasons. Stricter building codes, more focus on energy efficiency regs, the impact of more severe weather events.
Right, climate change impact.
And also the growing adoption of longer warranties. They mentioned 20-year warranties are now over 80% of the warranties they sell. People want that longer-term protection.
And it sounds like innovation is a core part of their strategy to capture that value too.
Absolutely. Their innovation efforts seem pretty focused. They talk about sort of evolutionary product improvements, making current stuff better.
Standard stuff.
Yeah, but also transformational new solutions and business lifecycle innovations, basically making things more efficient.
And they have a target for that.
They do. The goal is for 25% of revenues to come from new products by 2030. And they pointed to recent launches like Seam Shield, Blueskin VP Tech, Ultra Touch as examples gaining traction.
Okay. And one last thing, that MTL acquisition seems to be going really well.
Yeah, that was a clear positive note. They said it's not just meeting, but actually exceeding their initial expectations.
Exceeding how?
Well, they're now on track to get over $20 million in cost synergies from the integration. The original target was only $13 million.
So significantly better than planned.
Exactly. It sounds like their integration playbook is working really well, delivering substantial value, and they're seeing good collaboration between MTL and other parts of Carlisle, like Henry and CCM.
Okay, so pulling all this together, what's the key context for someone trying to make sense of this call?
Right. I think you need to see the Q1 results, the flat revenue, the slight EPS dip in the context of those known headwinds, right? The weather, the residential softness. These were expected to some degree.
So not a total surprise.
Probably not a total surprise. And the fact they reaffirmed the full year guidance, well, that suggests management believes these headwinds are manageable. They seem confident that the growth drivers are still intact.
Which are?
The strength in re-roofing, the contribution from acquisitions, the price increases they expect to stick in the second half, and that expected turnaround in CWT. Those seem to be the key pillars.
And the big share buyback increase.
Yeah, that signals confidence, right? Confidence in future cash flow. And it could also suggest management thinks the stock is attractively priced right now.
Makes sense.
Fundamentally, that focus on re-roofing, supported by how old so many buildings are, it gives the business a degree of resilience, you know? And then the focus on innovation and increasing content per square foot, those are the strategies for longer-term growth and better margins.
And the M&A success.
Yeah, the positive news on MTL highlights that they can create value through deals and good integration. So looking ahead, what you'll want to watch is, did those price increases actually gain traction in Q2?
Right.
And does CWT's performance start to improve as the automation benefits kick in? Those will be key indicators for hitting the full year guidance.
Okay, that clarifies things. Now let's shift to our segment where we toss around some ideas, strictly hypothetical, of course, our This Is Not Financial Advice segment. Based on all this, what's an outrageous but plausible trade idea?
Okay, outrageous but plausible. Well, given the strong emphasis on re-roofing resilience tied to aging buildings and their push for longer warranties, here's a thought.
Let's hear it.
You could consider a long position in Carlisle, really betting on that re-roofing strength. But to make it outrageous, you pair it maybe with a short position.
Shorting what?
Maybe shorting a basket of competitors who are much more reliant on new commercial construction, especially those offering shorter warranties.
Interesting. What's the logic?
The logic, or the plausible part, is that Carlisle's re-roofing focus and long warranties might make it outperform those more cyclical new build players, especially if the economy gets choppy. It plays on that relative stability. But again, total thought experiment, not advice.
Got it. Outrageous but plausible. Okay, that brings us to the end of our deep dive into this earnings call.
We've covered quite a bit.
We have the key results, the drivers, what to watch for. We hope this breakdown gave you some clarity and maybe some valuable insights.
But please remember, this is all just for informational purposes, definitely not financial advice.
Absolutely. What stood out to you in this analysis? What questions do you still have? We really encourage you to do your own research, dig deeper, and draw your own conclusions.
Yeah, always do your own homework.
Thank you for tuning in to TalkTickers. Join us next time for another in-depth look at the world of earnings.